In this and the next two videos, videos 34 and 35, we cover accounting for inventory. In this first video, we begin with an introduction and overview, followed by a discussion of manufacturing companies and inventory cost flow assumptions. Merchandise inventory, which means inventory for sale, as opposed to spare parts inventory used to support a manufacturing process. Merchandise inventory represents items held for sale in the normal course of business. And these inventories are absolutely the lifeblood of retail companies like Target and manufacturing companies like Caterpillar. Indeed, if the inventories of these kinds of companies don't sell at reasonable prices, these companies fail. It is that simple. Here's the assets section of the 2017 balance sheet of Target, the well-known discount retailer. As of January 28, 2017, Target carried $8.3 billion in inventories, which represented 69% of its current assets and 22% of its total assets. Target's income statement shows a cost of goods sold that runs consistently about 70% of sales, leading to a gross margin of roughly 30% of sales. On average, therefore, Target's sales price is about 1.42 times the cost of its sold inventories. In other words, Target marks up its products over cost by about 42%. Here's the operating section of Target's statement of cash flows. It reports an inventory decrease during 2016 of $293 million, which corresponds almost exactly with the decrease in the inventory balance reported on Target's balance sheet. The $293 million is a positive number on the statement of cash flows because it reflects the fact that during 2016, Target sold its inventories faster than it replaced them. Inventories decreased, which in general helped to boost its cash provided by operations. The negative numbers reported in 2015 and 2014 indicate that Target's inventories increased during those 2 years. That is, Target purchased inventories faster than it sold them, putting downward pressure on cash provided by operations. Here's the 2016 consolidated balance sheet of Caterpillar, which includes both its financial services and the manufacturing operations. It shows inventories of $8.6 billion as of the end of 2016, which is 27% of current assets and 12% of total assets. Caterpillar's income statement, called the results of operations, reports cost of goods sold for 2016 of $28.3 billion, which is 79% of the sales volume of its inventories, machinery, and energy and transportation equipment, leading to a gross margin unreported of 21%. In other words, Caterpillar marks up its products by 26% over their cost. Here's the operating section of Caterpillar's statement of cash flows. Note here that similar to Target, during 2016, Caterpillar's inventories also decreased by $1.1 billion in this case. In fact, Caterpillar's inventories decreased during all 3 years, 2016, 2015, and 2014. The $1.1 billion amount for 2016 corresponds to the decrease in inventory reported here on Caterpillar's balance sheet. And again, it is a positive number because during 2016, Caterpillar sold inventories faster than it replaced them, which helped to boost its net cash provided by operations. Let's now shift to a discussion of how the dollar amount of inventory is linked to net income. We begin with the simple expression that cost of goods sold is equal to beginning inventory plus purchases less ending inventory. Simply, what we started with plus what we purchased minus what we have in the end tells us what we sold. We see here how this expression relates to the income statement. where we have included some dollar amounts. Beginning inventory $1,800 plus purchases $4,000 less ending inventory $3,100 equals cost of goods sold $2,700, which is subtracted from sales $8,000, leading to gross profit of $5,300, and with expenses of $3,000 leads to net income of $2,300. Note that if we increase ending inventory by, say, $200, from $3,100 to $3,300, cost of goods sold decreases by $200, from $2,700 to $2,500, increasing gross profit from $5,300 to $5,500, and increasing net income from $2,300 to $2,500. Decreasing ending inventory by $200 to $2,900 has the opposite effect. It increases cost of goods sold, decreases gross profit, and decreases net income by $200, dropping it to $2,100. Thus, you can now see that whatever number ends up in ending inventory on the balance sheet has a direct impact on the net income on the income statement. If ending inventory goes up, net income goes up. If ending inventory goes down, net income goes down. Keep that in mind as we add another wrinkle. Period 1 ending inventory becomes period 2's beginning inventory, which affects period 2's cost of goods sold. Let's add some numbers and take a look at how this works. The interesting part here is that what we just demonstrated concerning how ending inventory affects cost of goods sold and net income in period 1 is naturally reversed in period 2. To illustrate, note first that in this example, an ending inventory of $3,100 for period 1 leads to a period 1 net income of $2,300 and a period 2 net income of $1,200. Let's say that for some reason an error, a change in estimate, or change in inventory valuation at the end of period 1 causes ending inventory to be $3,300, $200 higher than $3,100. Ending inventory goes up by $200. Of course, beginning inventory of period 2 is now also $3,300, $200 higher. We have already shown that this change in ending inventory causes net income of period 1 to go up by $200 to $2,500 through its effect on cost of goods sold and gross profit. What we show now is that the same change in ending inventory causes period 2's net income to go down by $200 from $1,200 to $1,000. This is called a counterbalancing effect. The effects on net income of inventory overstatements and understatements tend to naturally reverse themselves in future periods. A $200 increase in ending inventory in period 1 increases net income in period 1 by $200, then decreases net income in period 2 by $200. Here we illustrate counterbalancing in the context of inventory accounting. But this phenomena is a characteristic of the accrual system of accounting and actually occurs in many other settings, some of which we discuss in future videos. Now that we have a basic understanding of inventory disclosures on the financial statements and the relationship between inventory accounting and net income, let's shift the discussion to how inventory is accounted for and the 4 major issues that need to be addressed. The first issue is the acquisition of or purchasing the inventory, which normally involves placing the inventory on the balance sheet and recognizing an accounts payable. The second issue involves carrying the inventory on the balance sheet, and the challenge to companies here is to maintain an inventory system that enables them to both keep accurate track of the inventory and to recognize the outflow of the inventory and cost of goods sold every time inventory is sold. Which brings us to the third issue, which involves the inventory cost flow assumption. It determines the dollar value attached to the entry recorded at each sale. That is, the dollar value attached to both the cost of goods sold account as well as the reduction in the inventory balance. And finally, the fourth issue involves applying the lower of cost or market rule to the remaining or ending inventory. Applying this rule can require a company to book a loss on the income statement and a reduction in the inventory account if the inventory loses value after it is purchased and before it is sold. Let's move now to a little closer look at each of these four areas. When inventory is acquired or purchased, it is important to realize that the dollar amount that goes into the inventory account is made up of units purchased times cost per unit. For example, a company might purchase 5 units for later resale and pay $2 per unit for a total purchase cost of $10. These two components, units and costs, highlight two accounting questions that must be addressed by the purchaser. One, what units should be included in inventory? And two, what costs should be attached to those units? The general rule for units to be included in inventory is simply ownership. Once ownership is transferred from the seller to the buyer, the units should be included in the buyer's inventory. The general rule governing what cost to attach to the included units is any cost to get the inventory into sellable condition. These two general rules concerning the units to include and the cost to attach serve as guidelines that are easy to apply in a huge majority of the cases. Some situations, however, make applying the rules a little tricky. One example, which we cover in video 34, is with manufacturing companies. Once the inventory is acquired and recorded in the books, it is carried on the company's balance sheet. The key issue here is to maintain a perpetual, real-time if possible, record of the inventory purchases and sales. Assume a company has an inventory general ledger account with a beginning balance of 100 units at $1 each. Every purchase should be entered into the inventory account. Assume 50 units are purchased at $1 each. And at every sale, the cost of the inventory, assume 40 units at $1 each, should be removed from the account and recognized as cost of goods sold. If this is accomplished, the year-end ending inventory in the general ledger account, $110 in this case, will reflect the dollar amount, units times cost, that should be in the company's actual inventory in the company's warehouse or sitting on the company's shelves. When the year-end physical count is taken and the actual ending inventory is discovered, the dollar amount from the count, assume 108 units at $1 each, can be compared to the dollar amount in the ledger, 110 units at $1 each, to identify problems due to issues like theft, spoilage, breakage, and recording errors, which can then be addressed by management. Here it looks like we are 2 units short, each valued at $1. This would result in a loss that would have to be booked by the company. In this example, 2 units at $1 each. And note that this adjusting entry results in both a lower inventory balance and lower net income. In this example, which illustrates the perpetual inventory method because it maintains a real-time perpetual count of the inventory, we made two very important assumptions that often do not always hold in the real world. We assumed that the $1 purchase cost of the beginning inventory and the purchases made during the year was constant across time. The cost of the merchandise did not change. It remained at $1. Normally, the cost of a company's inputs change. Historically, they have tended to increase inflation, although sometimes input costs do decrease over certain time periods. We also assume that the company was able to specifically identify exactly which 40 items were sold. In reality, the nature and amount of the inventories dealt with by many companies make it difficult to specifically identify which exact inventory item at which exact cost was sold on a given date. As a result of constantly changing input costs and the difficulties associated with keeping track of sold inventory items, companies are allowed to make an assumption about the inventory cost flows, naturally called the cost flow assumption, item number 3. And this assumption has a direct impact on the cost of goods sold and inventory reduction amount recorded at the point of sale. There are 3 common assumptions. Take an average of the inventory cost, called the averaging assumption. Assume that the first items purchased were the first items sold, called first in, first out, or the FIFO assumption. And assume that the most recent items purchased were the first items sold, called last in, first out, or the LIFO assumption. All 3 inventory cost flow assumptions are acceptable under US GAAP. But under IFRS, LIFO is not allowed. In video 35, we explore cost flow assumptions in more depth. For our purposes here, it is useful to note that the assumption chosen by management, whether under US GAAP or IFRS, must be used from one year to the next. Companies are not allowed to change their cost flow assumptions from year to year. And the cost flow assumption has a major bearing on how the inventory acquisition costs are allocated between ending inventory on the balance sheet and cost of goods sold on the income statement, which in this case affects not only the company's net income, but also the income taxes paid by the company. The fourth and final issue is the application of the lower cost or market rule to the remaining inventory, the unsold inventory on hand as of the end of the period. In an application of the financial accounting principle of conservatism, which states, when in doubt, delay the recognition of gains and accelerate the recognition of losses, company management is required at the end of every accounting period to compare the cost of the inventory on hand to its market value, normally the amount the inventory could be sold for. If the cost is lower than the market value, no adjusting entry is necessary. If the cost is higher than the market value, the company must record an entry like the one here, which recognizes a loss and reduces the balance sheet value of the inventory to its market value. Here the inventory is considered to be impaired and is being written down. Interestingly, under US GAAP, if the market value recovers, comes back up, while the company still holds the inventory, no entry is recorded. What is written down stays down. US GAAP is very conservative in this respect. Under IFRS, if the market value recovers, the inventory is written back up to its original cost, but no higher, basically reversing the write-down entry. A recovery revenue is recognized. In addition to not allowing LIFO, this is another of the important differences between IFRS and US GAAP. We conclude the video by taking a final look at the footnotes published by Target and Caterpillar concerning the inventory cost flow assumption and their use of the lower cost or market principle applied to ending inventory. Here is the footnote in Target's financial statements describing how it accounts for its inventory. Because Target is a retailer, it is allowed to use what is called the Retail Inventory Method, RIM, which is simply a shortcut and practical means of estimating the inventory value under LIFO or FIFO. As you can see, Target uses the last in, first out LIFO assumption, and also values its inventory at the lower of cost or market. Here's Caterpillar's inventory footnote to its 2016 financial statements. It also states that the company's inventories are stated at the lower of cost or market, principally using the LIFO basis for about 60% of its inventory. The other 40% is partially explained by the fact that Caterpillar has a number of other companies included in its consolidated financial statements that use an assumption other than LIFO, some of which are held by companies that report under IFRS, which does not allow LIFO. Note also that Caterpillar reports that its inventory value would be over $2 billion higher if it used FIFO instead of LIFO. This is a very useful disclosure, which we discuss in video 35, which is devoted to the inventory cost flow assumptions.